Welcome to the big show. It's the Retire Young radio show. If you're a first-time listener, thanks for stopping by. I am your host, Joshua David, and we are always happy to have you with us today. As always, I have my great friend, the mastermind of this whole operation, Mr. Al Connickson. Al, how are you doing today?
Joey, I'm feeling really good. How about you, Josh?
It's been a while since I brought the Joey out.
Yeah, we missed Joey.
Yeah. Hey, and winter is officially back. How you like that?
Oh, that's just wonderful. I can't tell you how happy I am about that.
Are you ready for, another 6 or 7 months, and then we'll have sun again? Summertime,
No.
green grass?
No, I'm just going to get all big light bulbs in my office, so it looks like the sun's shining.
Well, since I ruined your day, let's bring that day up and talk about the financial markets. Let's help America with the financial literacy. And we're raising awareness to financial illiteracy right here on the Retire Young radio show. And Al, once again, we had another great week in the markets with a lot of volatility, which is just movement. So let's just change that word volatility. Let's call it movement.
Movement or opportunity.
So our listeners understand exactly what we're talking about. But there's more opportunities every direction now. I mean, most people are trading in one direction, which is just up. Today, we're going to talk about that up market, that down market, and that sideways market. So it's all just one opportunity. Before we do that, Al, let's recap what's happening. How can we participate in these markets?
Well, the markets are always providing opportunities. You know, you mentioned up markets and down markets. The market is going to move up and down. It's just what it does. It always has. It always will. We'll see these big moves up and down. In fact, especially now when we have such high valuations in some of these stocks, the handful of stocks that have really moved this market over the last 10 to 20 years, just during the last earnings reports that they came out with, a lot of them really got spanked. And the reason is because with those high valuations, actually perfection is priced in.
Yeah. Well, a couple of those tech stocks, they were good, though, a couple weeks ago.
Yeah,
the
absolutely.
fangs were.
Yeah, no, absolutely.
So it's kind of been a disconnect there.
Yeah, but what's happening is that people want these companies now to prove their worth. So when their valuations are high, and if they miss a little bit, then we have these big moves. But that's okay. That's just providing another opportunity. These are still great companies. Sometimes great companies get like I said, spanked a little bit, and it just moves them into a good buying position for us. Yeah. So the opportunities are always there. You know, I guess here's the question that people should ask themselves. There are 3 ways to potentially profit in these markets, in a down market. 3 different ways of participating in a down market. Do you know what they are, and do you know how to use them? If not, the only way you're really going to participate in a down market is to stay in and then count on diversification. The problem with that is that you're still losing, maybe just not as much, because Wall Street will have you in what they call their diversification, but typically you're still in correlated assets like all stocks or mutual funds. So the ways to make to have the potential to profit in down markets, there are 3 different ways to do that, and we'll talk about those today. But here, the number one thing that we really concentrate on, Josh, is helping our students. You mentioned financial literacy or illiteracy. That's our goal, is to try to really attack the illiteracy, the financial illiteracy.
Yeah. So with that, how do the markets really work? Like, how does it go up and how does it go down? Explain that a little bit.
Well, here's the first thing that you really need to understand. As a trader in the financial markets, the most important thing about a company is the stock price, because that proper price determines the probability of succeeding, the profit potential, and then the risk that there is in a trade. And here's what happens. History has shown us that combination of probability, high profit, happens at or near a turn in price. So it makes sense that we use what causes price turns when making our trading and investing decisions. What causes price to turn and what causes movement? It's an imbalance in the amount of buyers and sellers. It's that relationship between supply and demand, which in the markets doesn't make any difference what the market is. In any financial market, the supply and demand relationship, it really is impactful. When there's more demand for something in the financial markets, more buyers, price is going to go up. When there's more sellers, price will go down. So the key really is to identify where the big players are going to be buying and selling, preferably with a high degree of accuracy before they actually do it.
And who are these big players? You talk about the smart money, the big money. Who is that?
Yeah.
Is it the public?
Yeah. No, let me ask you this. if you had a company, Josh,
Mm-hmm.
and you came to me and you said, "Hey, I'd like you to invest in my company," and I said, "Hey, I think it's a great idea that you got there, a great product. Here's $5,000. I'm going to invest $5,000." Would that cause a whole bunch of people to go, "Hey, there's got to be something really great about this company. I'm going to."
5,000 isn't going to do it.
Okay, so what if instead of me, you went to your good friend in Omaha, Warren Buffett,
Yes.
and he said, "Yeah, I agree. I think it's a great company. I'm going to invest $500 million." Now, would people pay attention? And
people would pay attention now.
Yeah, and they would want to jump in. They'd be saying, "Hey, I want to participate in this. I want a piece of that action." And that's really what happens in the markets. It's the big money. It's the Warren Buffetts. It's the Goldman Sachs, J.P. Morgan, the hedge fund managers. And that's what we want to do. We want to follow them. And in order to do that, we need to be able to find out where that big money is going to be entering or exiting the market. Again, as I mentioned before, with a high degree of accuracy before it happens. That's what our core strategy, our foundational strategy for our students is designed to do. And we're trying through the financial education system to bring our students to the point where they approach and enter the markets with confidence and comfort using that core strategy.
And just to double down a little bit about following the smart money, I mean, when institutions, as Al was explaining, when they're moving millions, sometimes billions of dollars into these markets, they create these footprints on a price chart. And that is what you want to identify is where those footprints are. I mean, we're coming into wintertime. There's going to be snow. What do you leave behind you when you walk through a field of snow? A footprint. And that's what the institutions do. And that's why understanding to have a strategy like a core strategy that we're talking about is designed to help you make those better investing decisions by identifying where they are buying, but also where they are selling. So coming up next, I want to get more into continuing this discussion about supply and demand, how the markets really work. It's the big money moving the market, but how they are creating income in these financial markets. We have a lot of listeners that want to understand more how they're doing that. And these strategies and techniques that they're using are also available to the public. This is Josh and Al with the Retire Young radio show. We'll be right back.